There's a lot of interesting things happening right now in the housing market, especially surrounding interest rates and home sales. Because one thing that we continue to see, guys, that is just amazing and that nobody expected is just how high the interest rates continue to go moving forward with seemingly no sign of slowing down. In fact, when we look at where the 30-year fixed mortgage rates are right now, it is now back over 7%. The last time interest rates were over 7% for 30-year mortgages was the beginning of the summer, around like July. And you see that bottom there before the interest rates started going up? Yeah, that's when the Fed actually started cutting interest rates. That's back in September when they did their first rate cut. And you can see interest rates have absolutely skyrocketed since then. And it was supposed to do the exact opposite, at least what the Fed thought it was going to do. And some economists are now saying that this could be the return of higher for longer rates, and that maybe we won't see the Fed start cutting rates anymore, but I highly doubt that. But who knows? Let's take a look at what they have to say. See, this is what I was talking about in my last video, guys. I am really going to miss this view over here. Let me just share this with you. Super spectacular. According to some economists, they say the U.S. economy right now is facing too many inflationary pressures over the medium term in order to warrant policy easing. We have several headwinds that are fighting this idea that we're going to see inflation go down, because we have the federal debt that has swelled to over $35 trillion, and also economists have flagged rapid government borrowing as a factor that risks stoking inflation. Like, yeah, no kidding, who would have thought, huh? We also still have some supply chain issues as well as geopolitical tensions that could potentially cause inflation to be an issue further into the future than a lot of people expect. And some economists are also saying because Donald Trump, if he gets elected, he's going to impose tariffs on pretty much all imported goods, that this is going to be an extra tax on Americans, which is going to lead to higher inflation as well. So they're kind of looking at different things and different reasons to blame inflation for going up. But the biggest reason that inflation is going up wasn't mentioned here, which is that we've had a major increase in the money supply over the past 4 years. That's the reason inflation is out of control, and that's the reason it's going to continue to be out of control, and the government doesn't want deflation, so shrinking the money supply isn't really in their best interest. So we'll just look for other things that we can blame it on to try and like make people look the other way. That's the idea here. Like, let's just, look over there. Don't really pay attention to the fact that we injected $6 trillion of cash within a 2-year time frame into the U.S. economy. That's irrelevant. Essentially, what we could be looking at is 1970s style inflation, where it remains very sticky and is already starting to go back up, as I explained and showed you guys in my last video, as of the most recent inflation reading. A lot of economists are even predicting that the core inflation is not going to fall back to the 2% target that the Fed has been targeting. In fact, the prior month, it was at 3.2%. The most recent reading we got, it's at 3.3%. So it is nowhere close to the 2% that the Fed has been targeting. But interestingly enough, all of the headlines, like I was telling people in the last video too, the headlines will tell you that inflation has been squashed, that everything is good because the CPI is back to 2.1%. And when in fact the core inflation numbers are still sitting at 3.3%, which is far worse than what they want people to know about. And it's nowhere near the 2%. So even people who are bullish on the economy are starting to realize that we might not see a time where we go back to 2% core inflation, maybe ever, especially with the way they print money and all of the government's inflationary spending, which means all these companies that are hoping to refinance debt cheaply because debt is still very expensive are going to be sitting and waiting for a very long time, and that's going to cause a lot of problems for the ones who need that. You know, if you are looking to refinance debt right now and you were used to getting, a 2.5–3% rate on long-term debt, and now you need to refinance at 6.5%, well, now your borrowing costs have more than doubled. So imagine what that does to a business's bottom line. We could be looking at a new normal where interest rates remain between 4.5% to 6%. Look at that 30-year mortgage I just showed you guys earlier. It's sitting at 7% right now. If you want to get a 5-year auto loan right now, you could be looking at 7.5%, maybe even more if you have bad credit. And what you're going to see happen with these higher for longer interest rates is you're just going to see more and more companies struggle financially, and more of them start to go out of business because the entire business model was predicated on low interest rates, and that remaining to be the case indefinitely. And now that it's not the case indefinitely, the Fed can lower interest rates all they want, guys, but it doesn't really matter because the Treasury market is moving in the opposite direction. In fact, the 10-year Treasury is now sitting at about 4.4% and has moved up about 50 basis points ever since the Fed cut rates, which is a direct contradiction and directly the opposite of what the Fed wanted to happen after that interest rate cut. You know, so many people are like completely distracted with this election right now. I can even see it on YouTube. I see all the videos popping up all the time about he said this and she said that, and you won't believe what just happened with the election and blah, blah, blah. But guess what? In a couple more days, none of that's going to matter anymore because the new president will be elected and then it's all over with. And guess what? All these problems I'm talking about right here are all still going to be remaining. We're still going to have all of these issues. None of it's going to get resolved based on these election results. So this whole thing with the election is another way, another distraction that people are like, hey, look over here. This is exciting. This is interesting. We want our person to win. Let's stop focusing on the important stuff. But some economists are saying there's really no reason to expect any major interest rate cuts moving forward because, like I said, guys, the Fed can continue to cut rates, but they're not the ones who dictate borrowing rates because it's all about what can I get as a return on investment as an investor. And the higher that Treasury yields go, the more attractive that becomes for any investor to invest in rather than take a bigger risk and loan their money out for a higher yield. The more that these Treasury yields move up, the more interest rates on other types of loans need to move up to make it a more appealing investment for investors. It's that simple. And right now the market is pricing in a 95% chance that the Fed will cut interest rates by 25 basis points at the November meeting, and a 72% chance that it will be 50 basis points lower by the end of the year. So they're basically saying that we're expecting a 25 basis point rate cut in November and another 25 basis point rate cut in December. By the way, this is for sure will be the last video you guys see of me in the Bay Area until next summer, and there is a possibility I might shoot one more California video down in Burbank because I'm going to be stopping there before I head over to Arizona. But this for sure will be the last Bay Area video. So I really hope you guys enjoyed all the beautiful places and landscapes I've taken you along the way here. But it's also going to be fun to go back to Miami and see what's changed over there. Now, one thing that's been happening to a lot of people recently has been unjust rent increases, so much so that you're seeing buildings where they're increasing rents more on the current tenants than what they're offering new tenants for move-in specials. And this is wrong on so many levels because it's a huge negative for the current tenants. You're giving special treatment to somebody you don't even know versus somebody who's been loyal and paying the rent on time, and you're going to go ahead and give this new person a better deal. You used to see this a lot with the cable companies too. It always used to infuriate me when, you know, your cable bill would go up year after year, and then you would also get something in the mail from them saying, oh, you know, new customers qualify for this rate that's basically half of what I'm paying, you know? And you call them, of course, they're not going to give you that rate. Well, one of my viewers wrote me this story about the situation that's happening with them. So the owner of the apartment complex is Greystar, and apparently they're notorious for doing this sort of thing. The residents are being offered lease renewals at significantly higher rates than the new rents being advertised for similar apartments. Greystar has been unwilling to negotiate rent reductions or offer alternative housing options within their properties. At the same time, people that live there say they're seeing an increase in neighborhood crime like carjackings, robberies, drug use, shootings, and also apparently Greystar owns the lion's share of apartment complexes in the area, which basically gives them a monopoly on the local apartment market. And the thing is, if you move out of one of these Greystar properties, they won't let you move back in to a different one. You know, if you're trying to move out and avoid the rent increases, they won't let you move out of one where you say you're paying $2,500 a month and they're offering $2,000 another property. They won't take you. They'll deny your application. And a group of renters have been pleading with Greystar in order to essentially keep their rental rates close to what the new tenants are getting. Here's a personal example from one of my viewers. His renewal offer for rent is $2,828 a month plus a common area electric fee with no cap, which he was told that will be at least an additional $100 every month. So you're basically looking at $3,000 a month. He said, in fact, with all the other fees that they charge, his rent would be over $3,100 a month. Currently, all in, he's paying $2,800 a month. So this increase will essentially cause his rent to go up by $300 a month in just 1 year. To make matters worse, they also have raised the pet fee, so this makes it harder for most people to afford to even keep their pet, which can be significant, especially if you don't have any family, guys. Some people, you know, their dog is their child or their dog is their friend, you know. Without having that, it can impact someone's quality of life for well-being. To give you guys an example of how criminal this is, here's a little chart or table of different units that are available right now and their move-in offers, guys. You're talking $2,100 a month to $2,000 a month. Meanwhile, somebody like him has to pay $3,100 a month, essentially 33% more, just because he's been a loyal tenant. This is your punishment for being a loyal tenant. And you could say, well, you could just move, find somewhere cheaper, but it's hard, especially if this company has a monopoly on the local area, first of all. But also, moving sucks and it's expensive, you know? I'm moving out of this apartment here that I moved into here in California for a few months, and it sucks, guys. Like, everything's upside down. Luckily, we don't have a lot of stuff, so it's not going to be too bad, but still, it's a hassle. Now, another thing that just happened with real estate in the housing market is, for the first time in a while, is we've seen the Case-Shiller home price index dip down a little bit. And I haven't been talking too much about median home prices because there's really not much to say, guys. Because first of all, median home prices don't reflect the reality of most people. Each market is so different right now. This is such a bifurcated housing market across the United States. People are seeing drastically different things happen depending on where you live. And you can't just look at one metric like the median home price and say this is a reflection of what's happening nationwide, because it really isn't. But it looks like a lot of the markets that are seeing a lot of price reductions and selling prices finally start to come down, it's finally starting to weigh on the Case-Shiller home price index. You can see by looking at the chart that it was just an ever so slight drop as of the last reading. And remember that this data is delayed by several months because the most recent data is August of 2024, guys. So one thing we're likely to see is this number to continue to drop over the next few months, since this data is delayed so substantially because of how many markets have been seeing prices come down, and it's finally starting to show its face in Case-Shiller home price index. And when you throw in a wrench like interest rates going back up over 7% now for a 30-year mortgage, this probably isn't going to help the situation improve anytime soon. And like I was just talking about with the economists a little bit ago, that we could be stuck in this situation for quite some time, because it all comes down to what kind of return can an investor get. Is an investor going to offer you a 30-year mortgage, or am I just going to buy 10-year treasuries and have a safer investment? If that yield keeps going up, I might as well take that bet, which means that 30-year mortgage rates will continue to go up. You're seeing so many listings across the country with price cuts right now, so those homes are selling for less. And I strongly suggest that people go ahead and look at all this data for themselves locally where they live, because it could be a lot different where you live. But when you start seeing it happen as a national average, that means there's enough price reductions and enough homes selling for less than they were a year or two ago to actually start influencing the Case-Shiller, which I think is significant. And really, people should look at this as positive news, because what's the downside, guys? Only for people that grossly overpaid for housing over the past couple of years and who are now selling at a loss, which I've shown multiple examples of people doing that here and in Florida. It's happening all over the place. So you do see that a lot. But besides those people, prices coming down a little bit is a good thing for everybody, because it makes it cheaper for buyers as well as for sellers. It brings more buyers out of the woodwork when prices come down. So you have more people looking at buying your house. And if you bought more than 4 years ago, you probably still have a decent amount of equity even with prices coming down. So this is still a good thing for pretty much everybody. Another one of my viewers sent me this story about how much he pays in rent versus how much it would cost to buy literally the same apartment right next door to where he lives, which I thought was crazy. And this is down in LA, guys. Take a look at this. He says he pays $1,480 a month for his apartment. And if he were to purchase the condo next door, it would cost him $6,359 per month. The asking price on this condo is $799, which they already reduced down from $815,000. You have this guy who's able to rent this place next door for less than a quarter of what this other person is paying if they go ahead and buy the place. So the discrepancy sometimes between what it costs people to buy and rent is so unbelievable that it's hard to even imagine why somebody would buy a place like this. I mean, honestly, when you look at that big of a difference, guys, there's only two reasons I can think of why someone would buy. The number one thing is you just don't want to move anymore. You want to be certain you're going to be stuck where you're at and be there for a long time. Also, you have the money, right? Or sometimes, and the second reason would be kind of like you have too much money. You have all this money that you got to do something with, so I might as well buy this place, and maybe they even pay cash for it or whatever and lower their payment significantly from there because they don't have a mortgage. But otherwise, what's the incentive for anybody to buy a place like this if they could rent something for less? And I know $1,480 a month, especially in LA, is essentially unheard of, okay? But he did send me his rental statement to prove that's what he's paying, so I'll flash that up here on the screen to show you that this is legit. But even if it was still half of this price, even if you were paying, $3,000 a month like this last person versus $6,400 a month, that is a tremendous savings. Imagine if you saved that $3,000 a month, even without investing it, collecting no interest, not getting any gains on it from investing in the stock market, you're not investing it in gold and silver, nothing like that. If you save $3,000 a month just in a year's time, that's 36 grand. And then imagine adding a multiple on there for returns, guys. Say you invested in gold and silver. Say you invested in the stock market. Say you get it in a high yield savings account still earning 5% or higher in a CD like that. That is a tremendous amount of money that whoever buys this place is just going to completely lose out on. It's not available to them. And I noticed this here in California in general. The purchase prices here are so high that it really doesn't make any sense, and most people who buy probably buy for one of the two reasons I just mentioned. You either have just too much money, you got to do something with it, or you just want to make sure you're going to be secure in your spot and you don't want to leave, and that extra money is worth it for you to have a guaranteed place in life, like I don't have to move anymore, which I thought was going to be the case for me, but now I'm not so sure, which I'll talk about in a future video. And no, I'm not moving to California, if that's what you're asking. One other interesting thing that was sent to me that I figured I'd just share with you guys, kind of random here, but applies to all my Florida people, is that Disney just hiked their prices to enter their parks to their highest level ever, guys. In fact, if you want to go to Disney World in November or December, the prices are going to hit $199 per person just to go into the park for one day. This is going to be for November and December of next year in 2025. Right now, the highest level annual pass that Disney is also selling you costs $1,549 before tax, which is a $100 increase from the most recent price. I mean, I remember this stuff was expensive when I was a kid, and we went there a couple of times when I was growing up, but it was nowhere near this. I don't even know how parents are affording this now. Oh wait, I do. They're all going into debt over it, because we talked about that already a few months ago. Yeah, It's okay. It's a once in a lifetime experience. We'll take on the $10,000 in credit card debt for the trip to Orlando. No big deal. So I'm glad we got one last beautiful day up here in the Bay Area. It's been a really nice send off here. And if I don't catch you guys in Burbank, I will certainly catch you in Arizona for about a week of videos over there. So if you enjoyed this video, make sure to subscribe to the channel. And if you don't want to wait for my next video to come out, check out this one on the screen right over here, and I'll see you in the next one.